The clock is ticking on the so-called Trump tax cuts, and those are due to expire at the end of next year. So if you want to take advantage of lower tax rates now, you can do what is called a Roth conversion. A lot of people know about that. That money goes in after tax. But there's a tax guru that you know about. He's pretty big in the financial industry, much like you, Mike Kinnett. But he told Morningstar that there may be some people are skeptical because they think that the government will try to go after those Roth conversions. Listen to what he had to say.
I'm going to give you the secret that Congress doesn't want anybody to know. Don't worry about it. Congress loves Roth IRAs. I mean, loves, addicted, that kind of love. It brings in money. It helps pay for everything else. So luckily for us, they're so short-sighted. Remember, the only money that can get in a Roth is already taxed money. So they look at the Roth IRA as a revenue source. So I don't think they're going to kill their golden goose.
I get that, but Mike Kinnett, we all know how government works. Do you see a time when they would try to get a little bit extra blood out of the turnip there? Is that what the saying says?
Yeah. So I think, I mean, I want to agree with Ed Slott. I want to agree, you know, obviously he has some insight into the legislation that goes on, and he is, you know, considered a guru in our industry from IRA planning point of view. So I want to say that I agree with him. But having said that, no, there's no downside to actually hedging against what happens if he turns out to be wrong. You know, so you know, to that point, we just had Steve and Karen come in the other day. They were coming down from Bel Air. It was kind of a drive, so we appreciate them listening to the radio, but coming in, and they sat down with Ryan and Lawrence. And it was an interesting conversation because he was a little unsure about the whole idea of converting to a Roth, right? Mm-hmm. Because from an emotional standpoint, from a logical standpoint, they came in with the same idea that, you know, when we're finally done, we're going to be in a lesser tax bracket, which is absolutely a myth, right? I mean, most people don't want to have less income as you go into retirement. And this, you know, Steve and Karen were the same way. They didn't want to have less income. And as we went through their budget, it became apparent that they weren't going to need less money. They were actually going to need more money. So, you know, part of the conversation was how much do we actually have to budget for, and how much do we actually have to create? And creating those income streams is so important. And you know, we understand the importance of diversifying your investment buckets, right? We don't want to put all our money in one account or one investment. You certainly wouldn't buy nothing but the S&P. You diversify, and we understand we want to diversify our income sources, right? So you don't want to put all your money in the stock market or buy nothing but bonds or buy nothing but an income producing annuity or, you know, that type of thing. You don't want just one source of income. But the same is true is that you don't want one tax efficient bucket of money. And so when we sat down with Karen and Steve and we started looking at their options, what we decided was that the calculation we did is we looked into the future. So we knew by the time they got to be 73 years old, they were going to be forced, right? That's Uncle Sam's contract,
RMDs.
right? Yeah, it's his contract that
required
he has.
minimum distributions.
It's the agreement that he made with you. You know, I don't know if you recognize that when you signed that IRA and the 401k paperwork, but down there in the small print, it said, by the way, Uncle Sam is going to be your silent partner in this account. And yes, you're going to pay all the fees. You're going to take all the risk. But when time comes to take money out, they want their 1/3 share. And it's in the small print, and most people don't talk about it, you know, but fortunately in our practice, we bring it up all the time. So the fact is that if you currently have a 401k or a 403b or a 457 or a TSP or an IRA, and you failed to read the small print that said you have a partner with Uncle Sam,
which is most of us,
which is all of us for the most part, right? Yeah. If you did not take that into consideration, now is the time to think about it.
And that's what we see the majority of people calling in. Yeah, they've done a great job of saving, much. I'm assuming like Steve and Karen did from Bel Air, but they're concerned about taxes, and that's one of the just the nerves that we always touch upon, because that's what you guys work on when people call in wanting to spend some time with you guys and put a retirement plan in order. If you go to the SavvyInvestorRadio.com, again, that's the SavvyInvestorRadio.com front page tax strategy button, that will put you on their calendar. You can go to their Calendly page and you can schedule a time, quick 15-minute phone conversation to get things started. And you can do that on your time. You have control of that. As we're talking about the Roth conversions and paying the, you know, I guess taking the tax hit now before you're in a vulnerable position when you're retired. We'll just use Stephen Karen from Bel Air as an example. When you run the numbers and you say, hey, you got to take this tax hit now, do people get it and say, okay, I'm willing to do that now versus later, or they're still a little reluctant to give Uncle Sam that money right now? It's a hard thing to do.
Well, it's an emotional thing to do, but they do understand it because it's pretty much a black and white thing, right? We can show them, and just like we did with Karen and Stephen, we were able to show them that if they continued down the path that they were doing now, they were going to wind up paying about 1.8, almost 1.9 in income taxes over their lifetime. But by doing the Roth conversions, yes, we were paying a little bit more up front, but they ended up saving almost $800,000 in taxes.
Wow.
Now, I think $800,000 is a lot of money. And at the end of the day, I would much rather give $800,000 to my kids, to my relatives, to my friends, to charity. Heck, give it to the two of us. You can give it to Mike and myself. But there's got to be somebody who deserves the money and will use the money better than Uncle Sam. And that was Stephen and Karen's position, that they liked the idea of the Roth IRA, but what their concern is that what happens if they change the rules? Because they've heard us say on the radio that they've changed the Roth rules 3 times in the last decade, and that has not been in our favor. And to the point of Ed Slott's comment that he doesn't think the IRS is going to muck with the Roth, I don't think the IRS is going to muck with the Roth either. But having said that, what we do is we want to diversify our tax bucket. So we actually created strategies for people that have capital gains. So if you have a capital gains issue, we have a strategy on how to handle those in a tax efficient manner. Because if you structure your capital gain sales, right, the capital gain income correctly, it could be at the 0% tax bracket. When Social Security was first created, it wasn't supposed to be taxable. Well, Ronnie Reagan made 50% taxable. Clinton made 85% of it taxable. But if you structure your income correctly, Social Security can be tax-free. If you structure your RMDs correctly, your RMDs from your IRA can be tax-free. And that's really what attracted Karen and Steve to us. They wanted to make sure that they were as tax efficient as possible. And so to Ed Slott's point, I don't think they're going to change it, but I want to have a plan in place just in case.